Welcome to the MBA series. This is a special multi-part series within Next Economy Now. We are going to review the arc of the learning journey that is presented in the Next Economy MBA online course. We are open sourcing the content from our course and hope to share it in this shorter, bite-sized format. We are launching this series because we were asked to do it by listeners like you. We're also doing it because we are writing a book entitled The Next Economy MBA, Redesigning Business for the Benefit of All Life, which will be published on May 23rd, 2023 by Barrett Kohler Publishers. This is a sizable series. There will eventually be 18 podcast episodes of course content and 9 interviews with MBA alumni. We will be rotating every other week with our normal Next Economy Now interview format. We hope you enjoy it. Please reach out to us via our website, lifteconomy.com, with any comments, feedback, or requests. And now, on with the show.
Welcome to the Next Economy MBA podcast series on Next Economy Now. This is session 17 of this series, where we're diving into what we call Strategy 2, Fundraising, which is part of the Next Economy MBA facilitated training. My name is Kevin Bayuk. I'm a worker, owner, partner at Lift Economy, and I'm here with Ryan Honeyman.
Hey everyone, Ryan Honeyman here, also a partner and worker owner at Lyft. So maybe Kevin, do you want to kick us off with the first topic in this section, which is understanding business as usual finance? So what is that and why is it important?
I think the main reason why in the training we do a little background on business as usual approaches to fundraising has to do with kind of the comments we hear from entrepreneurs, teams, co-ops, individuals who are looking to start or grow an effort in alignment with Next Economy principles and values. So we'll hear comments like, I need to raise venture capital. Or on the other hand, there's kind of the other overcorrection of like, I could never raise venture capital. I could never raise capital, excluded from being able to raise capital. So I need to just bootstrap it and go alone. And in response in particular to that first refrain of like, I need to raise venture capital, we oftentimes find ourselves taking a step back with clients and participants in the Next Economy MBA and saying like, okay, well, let's understand what that means. The understanding, I think, is really critical because there's a lot of traps. But the more we can understand the way, at least the romanticized nature of business as usual finance, why it has an allure and why it has emerged in popular consciousness around like, okay, if you raise capital, you have to raise VC or venture capital. Unpacking it a little bit helps us understand why there might be traps there and why it's not necessarily a good fit for the expression of Next Economy principles. And so I think the main background that's important is to just understand that the archetypal or the prototypical kind of venture capital model. I think there's some kind of like naive notion like, okay, venture capitalists are rich people and they wire transfer $1 million to a company that they want to invest in, and then the company uses that money, and then maybe there's some vague notion of what happens from there. And I think that's the first thing that is critical to understand is most quote unquote professional investors, venture capital funds are structured oftentimes as a partnership, not exclusively, but that's predominant structure. And what that means is that the venture capital, the person who takes a meeting with an entrepreneur or a team, takes a couple meetings and decides whether or not we should wire transfer $1 million or $2 million or $500,000, $8 million, whatever it is, that venture capital, they're oftentimes not using their own money or not exclusively their money. So in most cases, there's a group of limited partners, sometimes they're called LPs. And so actually empathizing for a moment and understanding what the venture capital business model is in a business as usual context can be really critical to knowing if venture capital might be a good fit. Also helps for understanding how the business as usual economy has evolved, at least from early stage or startup enterprises. So these limited partners could be an organization like a pension fund, CalPERS, or the Stanford University Endowment, or a high net worth family wealth fund, a foundation. It could be, paradoxically, a charitable foundation that has a corpus, as they say, an asset pool of, say, a few $billion. And CalPERS and Stanford University Endowment or Harvard, these groups, they take a portion of their portfolio, if you will, of that total asset base, and they take that whole asset base and they spread it across what they would call like a diversified investment pool. So they'll invest in bonds and fixed income debt instruments and annuities and a healthy portion in the stock market, in indexed funds, etc. And then for a smaller portion, they'll invest in venture capital. So what it kind of looks like, almost like in a cartoonish way or caricature, is a venture capitalist, somebody whose career is to their vocation is to evaluate opportunities for investment. Their real career is actually to raise money, raise a fund, and then vet and evaluate potential investments, and then write checks, and then theoretically take a board seat or help in governance to steward companies to successful outcomes, and then outcomes meaning exits or liquidity, and then pay back those original limited partner investors. That's kind of the business model, but there's consequences there, right? So the first consequence is, if you can almost imagine a venture capital partner, a venture capitalist, going to a limited partner, goes to like the Harvard endowment kind of investment group and says, hey, we're raising a venture capital fund. We're going to raise a $500 million fund. And this is long before they've invested in a company, right? This precedes all that. So they go to the limited partner and say, hey, we're raising this fund. And the limited partner says, oh, well, tell me about the fund. What are you going to invest in? And so the venture capitalist says, oh, well, we're going to invest in this area, climate tech, or we're going to invest in health tech or pharma or biotech or something. They have a theme, right? An area of focus. And that's already predetermined, right? So they're already telling the limited partner what types of things they're going to invest in. And the limited partner says, what's in it for us? Like, what are the terms here? What does it look like? And the venture capitalist says something like, well, we're targeting a 30% internal rate of return, IRR. They use the term IRR just as a nuance here for listeners, because the actual returns to the limited investors might come in kind of chunks in different times, like not as a regular, it's not like debt. It's not like a regular annual payment. It is in year 6, there might be a big check that comes back to them. In year 7, there might be a small check. In year 8, there might be a really big check. And so it comes chunky, and so it's hard to evaluate like a rate of return without using the formula that for unequal distributions of cash flows, investors tend to use this wonky term, IRR, or internal rate of return, to be able to compare a return on investment compared to other investments. So the venture capitalist says, we're targeting 30% IRR over, let's say, 8 years. Maybe we can extend it 1 or 2 years if things are looking good. So within 10 years, you're going to get this 30% IRR return. That's what we're targeting. And the limited partner says, okay, that sounds good. We'll write you a $50 million check, or we'll pledge $50 million to that partnership, that fund. Okay, so you following me so far, Ryan?
So far, it's good.
I know you know all this. So then the venture capital fund has this $500 million fund, and there's these venture capital partners, and now they're out there looking for investments in that thematic area that they've promised that they're going to deploy this capital into. And they have a strategy of like, oh, we're going to invest at such and such stage, seed stage or Series A and Series B, and we reserve a certain amount of capital for follow-on investments. But generally, this promise, this expectation that they've set for the limited partner at that early conversation before they're making investments, has set into motion a particular lens that the venture capitalist almost perforce has to evaluate all of their investments, their potential prospective investments by. So in the back of their mind, the venture capitalist is looking at each investment opportunity and saying, okay, well, to get 30% IRR over 8 years, we're going to need some substantial returns here, so substantial winners. And instead of saying we're going to make, say they're deploying this capital, we're going to make 20 investments over the next couple years and hope that some of them, instead of saying we're going to make 20 investments and hope they all succeed modestly, and that's going to add up to a 30% IRR in 10 years. That's not the calculus that they use. The venture capital industry has, in order to achieve those prodigious return kind of promises or expectations, they evaluate each company by saying, can this particular company achieve a outsized 3x, 10x, 30x, 100x return? When I say 3x, 10x, I'm saying like if we invest over the lifetime of this company $5 million, they need to return $50 million. And the reason they set these expectations is because they know that it's difficult to grow at a pace and achieve liquidity. Liquidity meaning that they can pay back those limited partners in 8 years. That they're on the hook to be writing, achieve a 30% IRR in 8 years. That's pretty hard to do. And so they're looking at each company and saying, to use a sports analogy, which I'm terrible at, is this a grand slam? Does this company have multi-billion-dollar market potential? Are they going to grow quick enough? And kind of importantly for their business model, is it going to be liquid? Can I get money out of it in this short time frame to be able to pay back the limited partners? Is it going to go public, an IPO, file an S1 and be listed on an exchange? Is it going to be sold, acquired? It's a more common kind of exit, as they say. If they don't see that it has a multi-billion-dollar opportunity to, target market, addressable market, and they don't see the likelihood that there's an acquisition or an IPO in the future, then it's bad for their business model. Now, sometimes they'll look at a company and the entrepreneur is like, no, I want to create reliable prosperity. I want to create impact in my community. I want to do something wonderful for the climate or whatever. And the venture capitalists in the back of their mind are like, hey, that's all cute, but I have to return 30% IRR to the limited partners in 8 years. So they might not even tell. There's like this silent calculus that's happening of like, what can we do to help control this climate opportunity or this enterprise so that it has the potential to grow so quickly that it has a value inflection point where we can sell it in that 8 to 10 year time frame. And so when an entrepreneur says we want to raise venture capital, they're not usually saying like, in most cases, when an entrepreneur with next economy values and wants to express next economy principles says, I want to raise venture capital, they're oftentimes not saying, I want to try and exploit a multi-billion-dollar addressable market and sell the company and lose total control of it within an 8-year time frame. That's usually not in alignment with kind of the impact orientation of a next economy organization or a regional cooperative or any type of organizations that, in listening to this series or participating in the Next Economy MBA, that we would imagine you would start. And so almost categorically, venture capital is, because of its business model, not a good fit for impact organizations. This is why when somebody comes to us and says, hey, I want to raise venture capital, there's kind of like well, hold on a moment. Let's back up and make sure you understand the business model of venture capital, because what we just discussed, Ryan, is it's not usually transparently laid out. What's culturally known is like venture capitalists have lots of money, they invest money, and people get rich or something like that, or it works out for everybody. And it gets especially confusing when a lot of venture capital funds say we care about impact. That's the theme that they're looking for. We're impact investors, without the fine print of saying we're impact investors, but we still have a 30% IRR or 35%, 40% IRR expectation.
Can we quickly, just so folks know, that 30% IRR, just so folks have a sense of like how big a return that is. So let's say $1 million over 10 years with like a 30% IRR. Like what would the return have to be, just so people have a sense of like how big that number is to their fund?
I mean, it depends on the timing. So IRR is about timing. And so rather than, think of it as like a 3x or a 10x, something in that range in terms of return on capital.
Right. So 3 to 10 million.
Yeah, on $1 million. But it depends on how it could be a lower number if it comes sooner. And if it comes later, it has to be a bigger number. Yeah.
Okay, that's helpful. It's just for people. So then based on that, how VC funds work, what should a next economy entrepreneur know? Taking that, it's like, okay, so maybe I don't want to scale my company and like become a unicorn and like pay back an investor 10 million for the 1 million they invested. So then what do I do? What do I do with that information?
Yeah, well, I think having that information is important because you might save yourself a lot of time. And what's frustrating is that a savvy person might say, okay, well, that might be true of these professional venture capital funds. They might not be a good fit because they have this near-term liquidity, this exit expectation, and this outsized return kind of expectation. So, okay, they might not be a good fit. But what about like a high net worth individual, an angel investor, somebody who's using their own money? There's a number of those out there. And they don't have limited partners. They haven't made this like promise to the CalPERS or something like that, some pension fund to return this money with a particular time frame. They theoretically shouldn't care about the billion-dollar addressable market or near-term liquidity, right? But what's happened, I think, and again, there's many exceptions to this, so this is just a general pattern or caricature, if you will, of kind of the investment capital, and certainly in the American context, is that the glorification of venture capital, if you will, through popular journalism and storytelling has...
Well, that's why people think VCs are rich, because they see some VC who invested in Uber or something, and so they're like, oh, they must have all this money, personal money.
To be clear, they're in Silicon Valley. There are venture capitalists who, with their business model, they take a share of the upside.
Yeah.
So if they do carry, as they call it, if they do well with some of these biotech or health tech or high tech investments, they've made a lot of money. And they might also be a limited partner themselves and have some, as they say, skin in the game. So just for extra nuance there, they might be really rich. It's not there's reason to believe that there are certain venture capitalists who are rich. So what's happened is that pattern has influenced like the psychology of investing. One like really perverse thing that's happened that's I think worthwhile to understand is there's a notion that, a high percentage of startup companies will fail, meaning they're high risk. And I think we should like investigate that a little bit closer. Is it true that there's risk in starting something new and being an entrepreneur and trying to create an impact organization? There are risks for sure. It can be difficult, and we've talked about it through other parts of the series of what those difficulties are: team risk and culture, and finding the right market and the price parity paradox. And there are risks, but we should double click there a little bit because the business model of venture capital that says we have to try and force fit these companies to grow extraordinarily quickly, to have a huge amount of value inflection in a short period of time, to then exit and be sold, acquired, or go public, that actually increases the level of risk, because that in order to grow that quickly, in most cases, you have to spend a lot of money really quickly. The more quickly you spend a lot of money, it's like swinging for the fences. Again, not good at sports analogies here, but if you have to have a grand slam, you have to swing at every ball trying to hit a home run. You're not trying to bunt or get a single or a double or create reliable prosperity for your community. You have to be swinging for the fences each time. So you're going to strike out more. And the venture capital business model has, again, popularly created the condition where a lot of startups do fail. Now, again, there is risk in startups. Startups can fail without having venture capital money, but Now, if I'm an angel investor and I'm using my own money, I can kind of look at the world of startups and say, look, startups fail a lot. There's a high failure rate. So I deserve a reward, risk reward. So the reward I'm expecting is commensurate with what those venture capital funds are doing. And so here's an angel that has no limited investors using their own money, making professional investments, but they're so influenced by the business model and the popular conception of investment capital, venture private equity capital, that they also expect the same type of returns in many cases, not all. They expect the same returns. And so here's an entrepreneur who says, okay, well, venture capital is bad for me, but I'll go to angel investors instead because they're using their own money, so they're not beholden to these expectations. So I'll go talk to them. And my sad message to deliver to those entrepreneurs is, in many cases, if they're a professional angel investor, even ones that say, I'm an impact investor, they're going to use that word and self-describe them as caring about impact. The vast majority of those, in our experience, are so influenced by the culture of investing that they also are seeking this market rate return, venture returns, and liquidity profile, and they just want impact on top of that. And so now as an entrepreneur, you're kind of like really out of luck. It's like, oh no, I came to Lift Economy saying I want to raise venture capital, and I learned that venture capital is not a good fit for me. And these wealthy angels, by and large, are also not a good fit for me. So now what do I do? Now I'm really, I don't know what to do now.
Well, now we have Lift's 5-step plan. Five-step fail-safe plan.
Yeah, and rather than saying a fail-safe plan, there's like an approach. And our colleague and friend Jenny Casson of Jenny Casson Consulting, the Casson Group, would say, like, well, it's true that venture capital has this business model and angels tend to follow the culture of that. In terms of the potential investment capital that's out there, professional venture capital and angel investors is a tiny sliver, the capital that actually exists in the world to potentially invest. We have to expand our notion of who are investors and what investors are. And if we take a more expansive approach, sometimes we call this like alternative fundraising, but it's actually like more the mainstream. It's more, there's all these other options, and knowing those options, I think, is the first thing. And that's what you'll find in the Next Economy MBA and in the book, is that there's all these other options. And some of them are a little bit obvious, and so we say these steps. And the first one is, with caution around it, would be sometimes called bootstrapping, or basically we call it like finding financing from your customers. So if you have something and you've gone through the other parts of the book and the MBA, and you have a positioning and you have a hypothesis about what you want to deliver to your community, it's true that you still might need to raise resources. And in fact, there actually is a preliminary step here that we will be talking about in another episode of this series, is like knowing how much resources you need, doing a financial projection, an operating projection, and knowing in as much detail as possible a best guess of like how much resource you need to thrive is actually like a preliminary step, one of the preliminary steps. You actually need to know what you need so that you're not raising too much or raising too little. You really want to be in the Goldilocks position here for knowing how much you need to get to the next stage of development for the organization. But let's say you have a good sense for that number and you're trying to raise $1 million. Okay. One option is to look at your customers and say, like, is it possible that I can develop, and forgive some of the business as usual jargon, but a minimum viable product? What's the leanest way I can actually test the hypothesis of what I want to deliver and do some pop-ups or try and get some customers to actually purchase goods, even in advance of me delivering them? So maybe I need to acquire some supplies or some equipment. Can I get customers to purchase and then give me some time to go create the product, create the good, or deliver the service, design the service, and then actually have customers finance the growth of the organization? And popularly, this is known as bootstrapping. And there is a trap. Our friend Jenny would talk about the bootstrap trap. There is a trap of thinking that that's your only option, that you have to bootstrap. But there's another overcorrection where it's like, I'm not going to try and bootstrap at all. I'm not going to try and develop customer relationships or generate revenue. And I'm going to go raise capital without even trying. And so when we say it's a step, like that's one of the first steps. Like, let me see if I can actually get some funding from customers themselves, which is very validating. If you can get customers to purchase or pre-purchase your goods or services to fund the development of those goods or services, that's great proof that you have a great connection with the people that you're trying to serve. The second step would be to look at suppliers and partners or other stakeholders. This would be like if you need a piece of capital equipment in order to produce the goods, you're doing some preserves and you need a commercial kitchen with some, particular equipment. Is there the possibility of talking to the commercial kitchen owner or the equipment owner and saying, hey, would you be willing to let me use the equipment, deliver some goods, and pay you later? Which is a way of investing. That's an in-kind investing. They're extending the use of capital or material and sometimes that's actually cash. So finding partners that actually say, well, your growth, if you succeed in creating this impact for your community, is actually good for me because that means you're going to purchase more of my space at the commercial kitchen or more of my equipment or whatever it is. And so since your growth and your development as an organization is good for me, I can actually invest in you. Now, a lot of businesses that might be partners might not have cash capacity to actually write a check, but they might be able to offer you better terms on supplies. And so that might sound obvious to those of you who are operating enterprises, but it's a step that gets skipped oftentimes when people are saying, I need investment capital. They kind of skip over that step sometimes. It's like, well, what can I talk to my partners and develop relationships there where they can actually provide some of that funding or some of that equipment in advance. Another source in the steps is like, and it's worth just checking off the list, is like, can I access lending? Can I access bank or private debt? And this brings into this question, what's debt versus equity and so forth, but or even is there philanthropic? The philanthropic capital, so from foundations or from the government, and debt from public debt or private debt, these are what are kind of known as non-dilutive financing. And there's definitely, when you have a loan, there's like a promise to pay. So oftentimes there are fixed payments that are set on a schedule with an interest rate. So there's a downside to that, like you're kind of really on the hook for having enough cash to honor those obligations. Lots of ways to structure debt, which we can talk about, or we do talk about in the Next Economy MBA training. But in its most basic notion, you're kind of on the hook. So that has a downside. The upside is, though, you retain control the company, the organization, so that the pressure to sell or to exit or to compromise the impact, the beneficial impact, social and environmental beneficial impacts you want to create, you're not in a compromised position. Now, of course, some of you listening to this will notice right away, like debt, that's cute to say, Kevin, but when you look at the exploitation nature of the business as usual economy, there's a categorical exclusion. Banks notoriously, historically have excluded people of color, women, or they require huge amounts of collateral or wealth of the borrower. And those who have been excluded from wealth building categorically along lines of race, gender, that makes it much more difficult to raise debt. And those of you who are thinking that and observing that, you're absolutely right. And that's one of the gross inequities of the business as usual economy. So accessing debt can be difficult. And accessing philanthropy, whether it's private foundations or government money, or even small gifts from the community, there's work that needs to go into that. So non-dilutive capital can be difficult, but what we say when you said there's a 5 steps, keep that on the list. Make sure that you've done some thoughtful diligence, like, is it possible? Like, how much might we be able to get from non-dilutive capital sources?
One thing just to mention is, I think you may have mentioned this already, but just to double click on the reason we have this order of operations is not just to help you raise the most money, but it's also the control, like to retain the most control of your mission in your company. Because I feel like that's it's not just like, how do I get the money, right? This is also designed to like retain the most control or ownership.
Yeah, and it's back to that understanding the business as usual private equity, venture capital model, because venture capital is incentivized to have you swing for the fences, and which can lead to more strikeouts. And their business model is designed around, if you have an entrepreneur who wants to potentially compromise the perceived value of an organization, financial value of an organization, by creating beneficial impacts in their community. No, I don't want to pay minimum wage. No, I don't want to choose the lowest cost supplier of the good. I want to invest in regenerative land practices, or I want to find a supplier that treats their labor well and where the labor actually owns the facility, or whatever the case may be. I want to prioritize impact, but that's going to reduce profit or reduce the perceived value, financial value of an organization. Venture capital investors are incentivized to use whatever means they can, oftentimes the promise of follow-on investment or whatever, to take more and more control, to actually remove the founder from the equation or remove that team, such that the impact ultimately gets compromised. And that's happened time and time again in many different industries, where you find very jaded and founders who have been disillusioned by that kind of pattern. So maintaining control is important for maintaining impact, especially when control translates to distributing ownership within your community and having multiple stakeholders, where the intent is to create community wealth without creating investor wealth per se, or exacerbating those gross inequities. So non-dilutive capital is on that list. And then next on the list would be looking at this expanded group of investors. So the things like equity crowdfunding.
Or investment crowdfunding.
Investment crowdfunding. Yeah, thank you. Investment crowdfunding. And that's great. Investment crowdfunding is better because you could still do non-dilutive type of terms, but looking at the public at large. So this is, again, looking at your customers or your community or your region or the nationwide. There are now means to fairly easily create, through registered intermediaries, investment crowdfunding offerings that allow you to access a much larger pool of investors using smaller amounts. So when we were talking about angels, oftentimes you're thinking of millionaires, or maybe unprofessional angel investors. You might think of like professionals of careers that have very high incomes, doctors or lawyers or something like that. In this case, investment crowdfunding enables you to raise capital from, in many cases, broader swath. There's such gross inequities that I won't say everybody, but you could have a minimum investment of $100 or a minimum investment of $500. And so by setting that minimum much lower, that expands the pool of people that you could reach. Now, you have to reach them and have a message and a value proposition, and there's still some work to raise capital from this broader pool of investors. But before recent times, before the Jobs Act, and I think Obama signed that in 2009, it was very difficult in the United States from a regulatory perspective to access. Not impossible, but it was difficult to access an offering, creating an offering that could be funded by the population at large. And in the Next Economy MBA, you'll learn about, Reg CF offerings. You'll learn about the compliance strategies, Reg A, and all the different possible ways.
All the regs,
506B, 506C, and whether an investor is accredited or non-accredited. What does that term mean? There is some nuance here, and understanding that landscape is really important, and you'll find that in the facilitated training. But just knowing that this pool of investors exists, I think, is why it's a step on the list. And then the fifth step is to actually, if all of those are not workable and your organization and enterprise ambitions kind of fit, then there is a slice of that world of impact investors, and it's a growing group, and I wish it was growing way faster, that says, I'm an impact investor, and they actually mean it. What I mean by that is, when I was describing impact investors earlier, venture capital, professional investors, and angels, And I said they are self-proclaimed impact investors. Many of them are oriented around market rate return, near-term liquidity, plus impact, which does us no favors as Next Economy aligned entrepreneurs and teams. But there is a narrow slice of those markets that are authentically impact, meaning they're kind of impact first. I want to see the social, environmental, beneficial impact, and I'm less attached to, or I don't have the expectations of market rate returns. I still might want the money back. I still might want a return, but I've set different expectations for limited partners or an angel that says, I want to invest in patient capital. If it comes back in 20 years, if it comes back at a low rate of return, that's acceptable because I authentically care about the impact first of what's being created. It's a rare group. It's growing. I would estimate in the United States, there's maybe, $1 billion at the time of this recording under management that is kind of oriented around that type of hypothesis or thesis for investment. But it does exist. And in the training, we talk about who some of these investors are and how to go about finding them. And that's kind of the part of one of the steps. But it's you can see it's at the end of the list of the steps rather than starting with, I need to raise venture capital.
Absolutely. Are we going into security structure options?
Most of the detail there is good for the training or different types of equity or different terms of equity, how depending if your entity structure matters here, whether you're, an LLC, a co-op, or corporation. And there's some detail there about finding what is the right offering to investors, matching up what works for your aspirations. And, if you're going to offer equity used in this terminology, like ownership, selling ownership in the enterprise, who can you sell ownership to? What are the different terms? There's lots of nuance there to understand. And so we often get a lot of questions and answers of what's a good fit. Or if it's debt, what are the different ways to structure debt as an offering? The one that I would highlight for this episode, just to, again, in the spirit of sharing that there's things that are out there that exist that a lot of people, for a number of reasons, don't know about, is there's a number of ways to do what we call like structured exits. So ways for investors to invest in an ownership or in a debt-like instrument that actually gets their money out, again, in alignment with our values, not extractive and not in market rate return or near-term time frame, but get their money out without having the company to sell or go public, become a public listed entity. And these exits we call like structured. There's ways to bake into the terms. And I'll just mention one as an example, which is more like a debt instrument, is like an emerging world of revenue-based financing. And the example of revenue-based financing, Michael Looney Libas and others have popularized this kind of offering where revenue-based finance means that it's like the IRS kind of sees it as debt, but it acts a little bit differently in that you can peg the return, the payment return on revenue. So basically you can imagine terms like after the first year after investment, every quarter or every year thereafter, a percent of gross revenues, say 2% or 3% or of gross revenues will go back to the investor every year. And kind of no matter if the company is profitable or not. So the company just plans for it like we have this 3% royalty that we owe the investors every year. And then there could be a cap, like the investor gets 3% every year up until the point when maybe they've returned 1.5 the amount of money they put in. So they invested $1 million and they get 3% of gross revenues every year after the first year maybe, and until they get $1.5 million total returned. And that investor, then they're getting near-term liquidity. They're getting their money back, which from an investor's perspective might be good for them. They're getting their money back. From the business's perspective, they retain control. So it's like non-dilutive in that way. And the investor, if the company grows quickly with gross revenue, then the investor gets their money back sooner up to their cap. And so that means their IRR, looks better. Their internal rate of return is better, so the investor has a better investment kind of return on investment. But also, if the company grew gross revenues really quickly, that also probably means they're doing pretty well. So it kind of aligns incentives in a way that equity to take control for forcing an exit doesn't really align incentives around impact, and fixed term debt with an interest rate can be a burden. In this way, with a revenue-based finance, if the company slows down and decides to platform kind of the company to really focus on impact for a couple of years and gross revenues slow down, that's okay. That's okay for the company. That's okay for the investor, because the investor is still getting a return. It's just slowing down. So that would be one example of the plurality. There's like dozens of different structured exits. And again, in the training, we kind of go through those things.
Excellent. I think that captures the majority of advice for this podcast.
Oh, we mentioned some things in this podcast episode that might sound like advice. Ryan nor I are a legal counsel, and so anything we mention, we don't want to be construed as legal advice. Apologies for the disclaimer, but we're sharing examples of what's possible, and there's a lot more to learn in the Next Economy MBA. Nothing we said here, hopefully, should be taken as advice.
Yeah, as you can see, for listeners, I teed up Kevin to say that, so that was pre-planned. Totally pre-planned. Well, thanks everyone for joining. Hopefully this information was useful to you. It is a lot. So just if you're feeling like annuities and LPs and VCs and market rate returns, all these terms are hard to understand and follow. Honestly, it's part of why the system has been designed that way in many ways. It's like to make it hard and to make it exclusive. So finance has structural ways of excluding people from it by its own terminology. So we'd encourage you to check out the Next Economy MBA book coming out May 23rd. And then also, if you want to join the Next Economy MBA online course, we'd love to have you, and we go into some of the stuff in much more detail. And with that, thanks for listening.
Next Economy Now is a production of Lift Economy. To listen to all of our episodes, go to lifteconomy.com/podcast. That's LIFT economy.com/podcast. You can also sign up for our monthly newsletter at lifteconomy.com/newsletter. Please also rate and review our podcast on iTunes, Spotify, Stitcher, or wherever you get your podcasts. Thanks for listening.